Hey guys, Freaky Finance here. Today I'm going to do two videos. One's just going to be a quick update on Albertsons. You guys should check out the video I did, I want to say 2 months ago. Anyway, so today I'm just going to do a quick update on Albertsons. Going into the quarter, like I didn't know the information, I thought Albertsons would be safe because of COVID resistance, right? It's a grocery store, restaurants are closed, and that was the narrative. So based on this quarter, it turned out the narrative was right. Just for full transparency, I'm just going to pop this up. And you can see that I am currently down $400 or 6%. To some people that might be a lot. To me it's just an opportunity. It makes me look at the company more and say, am I missing something? And so that's why I wanted to dig into this video and say, hey, maybe I'm missing something, maybe I'm not. So right here we can see revenue shoot up $4 billion. $4 billion on a quarter basis is quite a big deal for a company like Albertsons. If I go back on their 5 years, you can see that the growth rate has traditionally been less than $1 billion. Well, the last year they increased it by $2 billion for a full year basis. But in our last quarter, they were able to do 22.7. Times that by 4 and you're at 88 plus, right? You're pretty much at 90 billion, which is quite the acceleration in revenue. And again, this is COVID, so there's a lot of noise in this quarter. But I want to point out that it was a stellar quarter for Albertsons, and I think the CEO got like 12 minutes of airtime, and that's all I've been able to find on YouTube about their quarter. I did listen to a conference call, I listened to a Goldman Sachs call, so I'll provide that information to go through the rest of this instead of the top line. Revenue growth, more importantly, outscaled COGS. The CEO did mention promotions, discounts lower. You're not going to be discounting your product when you have less supply, right? Because there was a kind of a supply run on quite a few key products during COVID, or the COVID quarters. Also, for the COGS was lower. He also said less spoilage, and again, that's a factor of supply. So your your inventory is turning faster, and therefore you have less spoilage on things like your produce, which obviously has the shelf life, and other items like have shelf life. So I'm thinking meat, for example. So anyway, less spoilage. That led to not only the sales increasing, but also the margin expanding. And we'll see that when we just go through the gross margin at the bottom. Here you can see it tick up. So 29, which is pretty high in the grocery store industry. However, SGA increased quite a bit. A lot of COVID costs were in there, so you had extra COVID appreciation pay. So this is harder to pick out because I know a lot of the grocery stores have stopped paying employees extra, but it's always a hard thing to do over time. So if this COVID continues, I would expect SGA to still stay higher, even if their initial appreciation pay or bonus pay is over. Anyway, I'd expect SGA to stay elevated in line with GMD being elevated, right? And that makes sense. And they also have incremental training costs because they had to hire quite a few more employees for the demand. And they also had COVID specific supplies. So that's your plexiglass and your cleaning supplies. And that's universal across so many income statements that I've gone through by now. The only other thing I want to point out is operating income tripled on a quarter over quarter basis. So that is quite big. The biggest question there is it sustainable? If restaurants solely open, then no. So I expect Q3 to be a little bit less stellar than Q2. But on a year over year basis, this company has improved dramatically from an operation standpoint. I also want to point out their interest expense is going down. Their weighted average interest rate is 6% now. It was 6.5%, and they have continued to decrease the interest expense. They're doing refinancing. Every company that has access to capital right now, that's large cap, is doing refinancing. So that's just because debt is cheap for certain people. It's kind of a dichotomy. Debt is cheap for performers, and if people are adversely affected by COVID, they don't get the money. So it kind of just reinforces this cycle of picking winners and losers, and that narrative is actually true. So I would expect Albertsons' weighted average cost of capital to continue to go down, and I'm going to go into an example. I think they just issued some debt in September or late August, and I'll go through that. Tax rate obviously is higher because they're making more money. Their net income technically was a 10x, but you got to remember 26% revenue growth isn't sustainable in a quarter. You don't want to just annualize this number, but you got to just the base thing here is that the business has improved in COVID more so than what I'd initially thought. However, the share price, if you look down here, IPO at 16. I just plugged that in here. It wasn't trading in June 2019, but you can see that the company's value used to be 9.2 billion, and now it's down to 7.7 billion, even though the underlying business has improved. And that's why I get excited, and that's why I talked about it last week really briefly and said it's my best idea. And I still believe that even if it's gone 6% against me, right? The long-term debt is something to always think about when you're thinking about Albertsons. So what I want to point out here is that their long-term bank indebtedness, 8.7. Their cash flow down here, you had 1.6 billion in the quarter, which means they could take a lot of this cash flow and pay down debt, and that would be a catalyst for the stock, because currently that's the narrative on Wall Street, is that Albertsons is full of debt. Full stop. So I mean, if it could take even just a billion of its 1.6 and pay it off, I know there's going to be repurchases or repurchase penalties or prepayment penalties rather, but that's what I would do. On the Goldman Sachs call, they kind of asked them what are they planning to do with this cash, and he didn't really give an answer, but he basically said that they're going to pay debt based on their algorithm. So that just tells me they're just going to the optimal debt level. Though if it was me, I'd be aggressively paying it down if you're trying to reward shareholder value. They could also do a special dividend or increase the dividend, but those are kind of, you don't want to do that if this quarter is completely noise, right? Then you're stuck with a higher dividend, and then the stock will react poorly when you eventually have to pull it, and the numbers come back down if restaurants ever open again. Raising dividends consistently is a harder thing to do, but they could do it. I mean, the cash flow's there, though I would focus on the debt if I was them. I want to talk about the private capital. So Albertsons is owned by like almost like a syndicate of private equity led by Cerberus, and like I said in the IPO video, they've been trying to get out, and the IPO is a way to get out. It's an exit strategy. They still have control of the board of directors in the collective sense, as basically 10% of ownership. They get the appointed director, and Cerberus still has 30%, and all these other private equity firms, just quite a few. Collectively, they own a large portion of this company. They can easily influence how, like, you need her to get a dividend increase, you need to go to the board. I mean, who owns the board? The private equity. So it's hard to, like, if I'm a common shareholder, obviously I'm just like, just pay down the debt. But if you're a private equity guy that needs money right away, you might feel like, oh, special dividend, we have extra cash. So anyway, we can see that EBITDA is quite high, not quite a double, but I mean, it did 1.4 billion in EBITDA in a single quarter. And like I said, that is quite high. I mean, I don't view this as sustainable, but it's likely the next quarters are going to be in some kind of midpoint in here, right? So you're looking at 1.1 billion, just a rough average, but we know Q3 is going to be better than last year's Q3, but we don't believe it's going to be as good as this last Q2. But we'll see what happens. I mean, restaurants aren't exactly booming, so, and people still need to eat, so this kind of superior economics for their shrinkage is less at the same time their volumes are accelerating and they're able to scale their business even faster is a pro. So technically the business improved and the share price moved unfavorably. So therefore it's a better opportunity than it was before. And that's how my brain just processes the information. I'm looking to buy, and I have bought, and I'm probably going to buy again. The EPS in the quarter is $1, which is really high. So just for context, if they do 4 quarters of this, I mean, you don't want to normalize a quarter like this because it's kind of outstanding, like an outlier almost, or it probably will be an outlier, but we don't know that, but it's likely. But you can see they have $1 in EPS. You multiply that by 4 for 4 quarters, you get $4 EPS. It's trading at 13. So I mean, what's that? It's very, yeah, 4x PE. But I mean, realistically, it's probably something sitting around like a 7x PE on COVID numbers. So when I see those type of valuations in a stock that's looking like it can improve its balance sheet with its existing cash flow, I mean, why wouldn't I take it? Just some notes at the bottom here, but I didn't bring up inflation yet. You never know if inflation rears its head, and then the company has to decide whether it's going to eat the inflation cost or pass it on to the customers. Usually they pass it on to me and you over time, but it's not immediate. So that could cut into their margins if there is inflation. Now that's something to keep in your back of your mind. It's harder to map. Like, I imagine there is going to be inflation, and I also don't know how easily they'll be able to push it on to me and you. So I do want to point out that they have taken advantage of the liquidity that's available to companies that have performed in COVID. So the lower interest rates with all this printing of money, it's kind of led for large companies to get increasingly favorable debt issuances out. So you can see here, well, what I talked about in the video 2 months ago is that on their debt to maturity here, you can see that the only big one was 2024, and I flagged that and said, well, it's a little bit high. Their their interest rate for that year is also very high. So what they decided to do, pay that out right now, and then issue more debt at a lower interest rate and push the maturity schedule out farther. So when I go back to that headline, it's going to make a little bit more sense. And that's what you'd expect for the CFO and their team to take advantage of this environment, right? So they were able to issue 750 million at 3.25 and 750 million. And anyway, they're going to take a little bit of cash on hand and the money from this issuance up here, and they're going to pay down that 6.63% that was due in 2024, and then some partial one at 5.75. So, I mean, if you just take the delta in interest rate saved right there, it's going to be quite large. They're going to continue to decrease their interest expense and at the same time push out their maturity schedule. So that's a pro for Albertsons. I mean, I didn't view the maturity or liquidity risk to be high for a company that's accelerating into the pandemic, but it's going to favorably improve their earnings over time. And hopefully they do more moves like this, or they literally just start paying off more debt with cash. Like I said, that's my preference. Here's the balance sheet from the Q2. And I wanted just to point out the only real delta here you're going to see is the cash increase. And like I said, free cash flow increased 1.6 billion. Right now, during COVID, it's a cash machine. Initially, I thought that increase was due to the convertibles that they issued. That was like when I first saw the cash, I was like, oh, it must be from this convertible. But really, they just marked the convertible here, and then they had the treasury stock down here. So I'm going to talk about the convertibles. It's why I think the stock has underperformed like it has, or one of the reasons. So right before it IPO'd, basically Apollo's like, I'll give you $1.75 billion if you do this for me. Basically, they negotiate fairly favorable terms for Apollo. In hindsight, I think. I mean, going into the IPO, maybe Cerberus was thinking, or the private equity was thinking, I'm not going to get the price I want, so there's a way to get what I want. I'll talk about Cerberus in a second because this is connected to it. So Apollo and Albertsons negotiate these 6.75% dividend yielding preferreds with quite a few takers in here. They're convertible as well. Each preferred share is worth 58 common shares, but they also have like a redeemable option, which is good for the company, but they actually can't redeem it until 2026. And what they do, they have to pay 105%. They also have an escalator in there for the dividend. So if the dividend increases, obviously the preferred shares will participate in that. It is kind of standard, but the timing kind of sucks because we just saw that Albertsons can raise money at 3.5. So why issue preferreds at 6 and 7.5? I mean, from an EBITDA standpoint, or I mean, from an earnings standpoint, the interest is tax deductible, whereas the dividends won't show up on your earnings, right? They're just the dividends. And it puts another barrier between the common equity and the debtors, right? The preferreds technically rank higher in the liquidity structure, but we don't really need to worry about that for Albertsons. But yeah, it's kind of like, well, if you can issue debt at 3, why would you issue preferreds at 6.5? Technically, maybe they didn't know they were going to be able to issue that much debt, but it's more likely. You can see right here so when they broker this deal, Albertsons pays the money, obviously. So Albertsons got 1.75 billion, well, less than that because the bank always gets a cut. And then what Albertsons did, they used the proceeds from the convertible preferred share stock to purchase a bunch of shares from its outstanding common stock from certain existing shareholders at $16.53. So basically, it allowed certain existing shareholders, and you notice this is the date before it's IPO'd, so it's not me or you, it's the private equity. So this this Apollo transaction kind of was almost like a pre-IPO in a way. Well, that's how I would view it, and I think the stock market viewed it that way. Basically, Cerberus, or I shouldn't say Cerberus because technically I don't know, but I imagine it is. The private equity syndicate was able to get some money from Albertsons before it IPO'd at $16.53. And then you had the market saying this thing's going to start at 18 to 20. And then the market's like, well, private equity just got in at $16.53. They're selling at $16.50. That's probably more realistically what it's worth, right? I digress there, but it's important to keep this. I guess one of the cons with this is the governance and the fact that it's still private equity driven. It's not common shareholder driven. Technically, we should all be aligned, and I think we are, but so far, the market's saying, I don't believe you. I don't trust you anyway. And trust is important. I do want to end on another note here. So on September 14th, Gabriel Assets was basically court mandated to wind down. It says right there. And what that means is that Gabriel needed to get some money, and they own shares in Albertsons. But under private equity, normally when you participate in IPO, you can't sell your shares readily on the market. Usually there's like a lockup period. And so they negotiate with Albertsons, and Albertsons says, this time in a position of strength, we'll buy it from you. Yeah, we'll buy it from the shares back from you at $12 a share. And that time it was trading around $13.50 like it is now. So a discount to the market share. So obviously it's not a favorable transaction for Gabriel, but it's an immediate loss. But I mean, they get the money when they need it, which is right now because they're mandated to sell. And when I look at Gabriel just to figure out who they were, you can see on SEC's website, you can see that it's the care of Cerberus Capital. So it's like, in my mind, maybe it's explaining why the share price is under so much pressure, even though the underlying fundamentals are actually improving dramatically. I think it's just this immediate or this kind of short-term liquidity issue for its private capital, where it needs to raise some money and is slowly selling. I mean, it's not, shouldn't be entirely true, but it's likely. Well, if we know you're going to have to sell at some point, why not make you sell low and take advantage of you? And maybe that's what the market's trying to do, take advantage of private capital firms. And that would make sense in my mind if I knew that a company needed X amount of money. I could just drive the price down as much as I can, and I know they're going to need X amount more or sell more shares, right? That's just entirely conjecture, right? But I mean, this trend with the Apollo trend, needing the money before the IPO, not getting the price they wanted at the IPO, I don't know, but I think the private equity aspect of this business is impacting the share price. And then you have to ask yourself, is the current board of directors more aligned with themselves, or are they aligned with the common shareholders? Technically, they should be aligned with both. But again, if they need money right away and I want money over a long period of time, that's why I'm thinking pay down the debt. That makes more sense for me. But they might be saying, well, issue a special dividend because I need the money now. I mean, overall, we're both going to improve. The business improves over time, but it does create this kind of angst in my mind. And perhaps that's the reason for the opportunity. Anyway, that's kind of my thoughts on Albertsons. So overall, stellar quarter. They're doing the right moves on the finance side, and they do have the private equity overhang, which is something to worry about. I'd like to hear your thoughts on Albertsons. It's an interesting story, and the more I kind of dig, as you can see, just I was like, okay, links back to Cerberus, links back to Cerberus. So it's kind of it's interesting. And I'm probably going to do another update on the Q3 just to see if this continued trend in EBITDA continues, and if the CEO provides guidance on what they're going to do with this extra cash flow that it's making. All right, so thanks and have a great weekend.